Sunday, January 18th, 2026. The world just changed, and nobody saw it coming. Right now, the mainstream media is laughing. They're making jokes about the president trying to buy a frozen island in the Arctic. They're interviewing Danish politicians who are outraged. CNBC is treating this like entertainment, a circus. But while the media is laughing, the bullion banks in London and New York are screaming. Because buried in that executive order, hidden behind the headline about purchasing Greenland, is a single sentence that effectively destroys the logistical pipeline of the global silver market, a 10% tariff on 8 European nations, including the United Kingdom, starting February 1st. And if the Greenland deal doesn't happen, that tariff jumps to 25% on June 1st. I am Ken Au. Welcome to the Vault. Today, Trump just accidentally built a wall around silver. And by the end, you'll see why London can't survive past Monday. To the average person watching cable news, this sounds like a trade dispute. Politics, negotiating tactics, leverage. But to the risk manager at JP Morgan, at HSBC, at the major bullion banks that move billions of dollars of silver across the Atlantic Ocean every single month, this is a nuclear bomb. Let me explain the mechanism they don't want you to see. The global silver market relies on something called fungibility. It relies on the idea that a 1,000-ounce bar of silver sitting in a London vault is the exact same thing as a 1,000-ounce bar sitting in a New York vault. And more importantly, it relies on the ability to move that bar back and forth, cheaply, easily, instantly. The banks play a game, a shell game, a logistics trick. When the price of silver rises in New York because of high demand, the banks take silver out of their vaults in London, specifically from the LBMA, and they fly it to New York to flood the market and push the price down. Conversely, when London runs dry, which is happening right now due to Indian and Chinese demand, they take silver out of the COMEX vaults in New York and fly it to London to refill the shelves. This constant flow of metal across the Atlantic is the lifeline of the suppression scheme. It allows the banks to pretend there's always enough silver because they can just shuffle it to wherever the fire is burning hottest. Whack-a-mole, price control, arbitrage, the illusion of liquidity. But what happens when you put a 10% tariff wall in the middle of the Atlantic Ocean? The United Kingdom is on the tariff list. The LBMA, the London Bullion Market Association, the beating heart of global physical silver trade, is located in London, which is in the United Kingdom. This means that starting February 1st, if a US bank ships silver to London to bail out the LBMA and then tries to bring that silver back to the US later, they will have to pay a 10% tax on the value of the metal. At $90 an ounce, that's a $9 tax per ounce. That destroys the profit margin. It destroys the arbitrage. It makes the whack-a-mole game mathematically impossible to play. President Trump just turned the United States border into a one-way valve for silver. Metal can come in, perhaps, if it comes from a non-tariff nation like Mexico. But metal cannot leave for London, because if it leaves, it can never come back without a penalty that wipes out the bank's equity. This is where things stop making sense. Think about what this creates. A trapped inventory scenario. The risk managers at the major banks are looking at this executive order right now on a Sunday, and they are issuing a stop move order. They are telling their logistics teams to halt all exports. They cannot risk sending metal to London if they cannot get it back. This effectively cuts the LBMA off from the COMEX. It severs the connection between the world's two largest pricing hubs. It breaks the bridge. And this is happening at the worst possible moment for London. We know, based on vault data, that London is critically short of physical metal. The flows to India and China have drained the LBMA vaults to historic lows. They were counting on emergency resupply from New York. They were waiting for the cavalry to arrive. But because of this tariff announcement, the cavalry is not coming. The silver that was supposed to fly to London, it's grounded in New York. Let me walk you through the logic every risk manager on Wall Street is facing. You're a bullion bank. London is desperate for silver. You want to ship 1 million ounces from New York to London to stop the bleeding. Sending it there is easy. No export tax. You put it on a plane, it lands, you save the day. But next month, when you need to bring that silver back to New York to settle a futures contract, you have a problem. That silver is coming from the United Kingdom. It's hit with a 10% tariff at US Customs. If silver is trading at $90, you pay the US government $9 per ounce to bring it back. That $9 comes directly out of your profit margin. In the low-margin world of bullion banking, a 10% hit isn't a loss, it's a catastrophe. The risk manager looks at the spreadsheet and says, we cannot send the silver to London. Once it leaves US soil, it costs us 110% to get it back. The silver is trapped. This destroys the whack-a-mole game. The banks can no longer smooth out the volatility. If London spikes to $120 and New York stays at $90, the banks cannot step in to close the gap because the tariff wall is in the way. This creates market segmentation. It means we're going to see wildly different prices for the same asset depending on where it's sitting. Silver in New York, $90. Silver in London, $110, $120. maybe higher. Why? Because in London, the metal is scarcer. And because it cannot be arbitraged away due to the tariff, the price difference will stick. This kills the concept of a global spot price. If you have a price in Shanghai, a price in London, and a price in New York, which one is the real price? The answer, the one where you can actually get the metal. And here's the accidental genius of this move. The media is focused on Greenland. They think this is about ego. They think it's about real estate. They think it's about Trump being Trump. But look at the effect of the policy, not the headline. By trapping silver in the United States, President Trump has created a domestic strategic reserve. By trapping silver in the United States, President Trump has created a domestic strategic reserve. If the banks cannot export silver to London because of the tax risk, that silver stays here. It stays in the COMEX vaults. It stays available for Tesla. It stays available for Raytheon. It stays available for the U.S. Mint. It forces the ghost supply to remain within the borders of the United States. This is America First applied to the periodic table. It forces the rest of the world, specifically Europe and the UK, to fend for themselves. It tells London, you're on your own. You cannot raid our vaults to save your exchange anymore. Someone knew. This move was prepared. This puts the LBMA in a death spiral. London is the hub of global physical trade. The vast majority of silver flowing to India and China passes through London. If London loses access to the US stockpile, they have zero buffer left. We know their vaults are empty. We know the float is gone. And now we know the resupply line is cut. This explains why the 4.2 million ounces that were withdrawn from the COMEX on Friday are so critical. On Friday, we thought that metal was leaving the country. But with this tariff announcement coming on Sunday, that metal is likely stuck. It's sitting in a warehouse near JFK Airport, wrapped in plastic with nowhere to go. The owner of that metal has a choice. They can ship it to London and eat the future tariff risk, or they can keep it in the US and sell it to a domestic buyer. Given the uncertainty, the smart move is to keep it here. This means that the physical squeeze in the United States might ease slightly in the very short term, but the physical squeeze in London is about to go nuclear. And because silver is a global asset, if London breaks, the whole system breaks. You cannot have silver trading at $200 in London and $90 in New York for long. The panic will spread. But there's another layer to this logistics trap. Many of the major refiners that supply the US market are located in Europe and Canada. If the tariff applies to any and all goods from these nations, then imported silver bars just got 10% more expensive. This raises the replacement cost for US dealers. If APMEX or GM Bullion wants to buy silver and the US mint is closed, they often buy rounds from private mints. But those private mints buy grain from refiners. If the refiners in Europe, the cost of that grain just went up by 10% overnight. That cost gets passed on to you. So even if the spot price stays at $90, the premium on physical silver in the US is about to jump again. The dealers have to price in the tariff. This bakes inflation into the physical product. But let's talk about what this does to the refiners. Most silver entering the US market comes as refined bars from European refineries, Switzerland, Germany, the UK. If those refined products now carry a 10% tariff, the entire US supply chain just got hit with a 10% cost increase. Even if US companies want to avoid the tariff by buying from domestic refiners, there aren't enough. The refining capacity in the United States was built when we could rely on cheap European imports. Now domestic refineries will be overwhelmed with orders. Lead times will stretch, premiums will explode. Industrial buyers who relied on just-in-time inventory are realizing they need to stockpile now. This creates a feedback loop. The tariff creates panic. Panic creates hoarding. Hoarding creates scarcity. Scarcity creates higher prices. Higher prices create more panic. And the banks can't intervene anymore because the metal is trapped. We're watching the balkanization of the financial world. The globalized, frictionless trade of the last 30 years is over. We're entering a world of walls, tariffs, trapped assets, regional markets that no longer speak to each other. In this world, having physical metal in your own possession is the only safety. You don't want to own a contract for silver in London if London can't get delivery. You don't want to own an ETF that stores its metal in a jurisdiction targeted by a trade war. You want the metal in your hand. The Roach Motel effect means that any silver that enters the US financial system is never leaving. It's being hoarded by the state, by the banks, by industry. The logistics of the trap are perfect. It freezes the banks in place. It stops the shell game. It forces them to show their hand. And when they show their hand, the world will see that they're holding nothing but paper. The Greenland Tariff just killed the silver market. 10% tariffs. Just cut off LBMA. We need to shift our focus across the ocean to the LBMA, to London. Because while New York is trapped, London is starving. The London Bullion Market Association is the beating heart of global physical silver trade. While the COMEX in New York is a futures casino, a paper market, London is where the big physical deals are settled. Real metal, real delivery, real flows. For the last 3 years, London has been bleeding. We've watched a relentless exodus of silver from the LBMA vaults toward India and China. The inventory in London has dropped to levels that many analysts consider critical. The amount of silver that is unencumbered, meaning it isn't already owned by an ETF or locked into a contract, is frighteningly low. London has been surviving on a lifeline. That lifeline was the ability to import metal from the Americas when things got tight. When the vaults in London ran dry, they could call up the bullion banks in New York and say, "Ship us millions of ounces." And the banks would do it. They would execute a location swap, move the metal, keep the game going. But yesterday, President Trump cut that lifeline. He made that transaction financially toxic. No bank in New York is going to ship silver to London if they have to pay a 10% penalty to bring it back. So London is now an island, literally and financially. They're cut off from the COMEX. They're cut off from the Mexican supply chain. And they're still facing the insatiable demand from the East. This creates a siege mentality in the city of London. When the sun rises on Monday morning, the traders in London are going to realize they are insolvent. Not legally insolvent, but physically insolvent. They have sold more silver than they have access to. And the backup supply from New York is not coming. Let me walk you through what Monday morning looks like. 6 a.m. London time. The LBMA trading desk opens. The head trader checks the wire. He sees the tariff announcement. His first call is to New York. Is the cavalry coming? The answer: no, the silver is grounded. 6:30 a.m. The phone rings. It's a procurement manager from India. We have a contract for delivery this week, 2 million ounces. When does our metal ship? The trader stalls. The buyer threatens arbitration. 7 a.m. The silver price opens in London. The opening print, $94. That's $4 higher than Friday's close in New York. The gap is real. The bifurcation has begun. This is the recipe for a local default. We could see a situation where the price of silver in London disconnects completely from the price in New York. We could see silver trading at $90 in the US, but $110, $120, even $150 in London. Why? Because in London, the metal is scarcer, and because it cannot be arbitraged away due to the tariff, the price difference will stick. This is called bifurcation, the splitting of a single market into two separate markets that no longer talk to each other. The law of one price has been repealed by executive order. And this bifurcation is a nightmare for the banks because it destroys their hedging models. Most banks run a global book. They might be long silver in London and short silver in New York. In a normal world, these positions cancel each other out. They're hedged, balanced, risk neutral. But if the price in London screams higher while New York stays flat, their hedge breaks. They start losing money on the spread. This forces them to close their positions. They have to buy back their shorts in New York and sell their longs in London. This creates buying pressure in New York. The tariff that traps silver in the US actually forces the US price to rise. The banks have to buy COMEX contracts to cover the risk that London blows up. So the idea that trapped inventory would crash the US price? Wrong. It creates a panic bid as banks scramble to rebalance their broken books. And let's talk about unallocated accounts in London. Millions of investors hold unallocated silver with LBMA member banks. This is essentially a fractional reserve banking system for metal. You don't own specific bars, you own a credit, a promise, an IOU. If London is cut off from supply, the risk of an unallocated default skyrockets. If you hold unallocated silver in London, you're basically holding a paper IOU from a bank that just lost its main supplier. When the market realizes that London is besieged, we expect a massive run on unallocated accounts. Investors will rush to convert their unallocated credits into allocated bars. Physical metal, serial numbers, proof. But there aren't enough bars. This forces the banks to go into the open market and bid for any metal they can find, any price, any premium, whatever it takes. This is how a liquidity crisis turns into a solvency crisis. The Greenland Tariff has exposed the fragility of the entire system. It showed us that the silver market is not a unified ocean. It's a series of connected pools. And right now, London is draining fast. New York is filling up with trapped capital that cannot leave. This makes the US market the most secure market in the world. If you own physical silver in the United States, you are holding strategic inventory. You are holding metal that cannot escape, metal that is locked inside the fortress. But if you own paper in London, you're holding a liability that is about to be tested. The divergence between the two markets will create chaos. On Monday morning, we might see the arbitrage bots malfunctioning. We might see spreads that make no sense. We might see price action that violates every textbook rule. This is what happens when the logistics break. The pricing mechanism fails. And remember the 4.2 million ounces we discussed, the Friday night withdrawal from the COMEX. We can be almost certain that metal is now stuck. The owner of that metal is sitting on a pile in New York that they cannot export without a 10% loss. So what will they do with it? They will hold it. They will wait. Or they will sell it to a domestic buyer like Tesla or the US Mint. This implies that the domestic supply in the US might stabilize, but at a much higher price point. The tariff trap is the ultimate unintended consequence. A dispute over an island in the Arctic has triggered a meltdown in the city of London. It proves how tight the market truly is. In a market running on fumes, a tariff is a spark, and the spark just hit the powder keg. So what does the future look like? We're not going to make a prediction for Monday morning's exact opening price. The price could gap up $20, or the banks could try to smash it down one last time in a desperate move to shake out weak hands. Instead, we're going to look at the long-term structure. We are entering the era of regional pricing. In this new era, the price of silver will be determined by where it sits. Metal inside the United States will trade at a premium. Strategic silver, domestic silver, protected silver. Metal in London, however, is now stranded silver, disconnected from production in the Americas, cut off from resupply. This bifurcation destroys the ability of the commercial banks to suppress the price. Suppression requires certainty. It requires the ability to move metal globally to bail out whichever market is burning. But the tariff introduces basis risk, the banker's nightmare. If the tariff wall prevents moving metal, their hedge falls apart. They're exposed. When banks face unquantifiable risks, they stop shorting. They reduce leverage. They exit the game. The paper shorts are leaving the building because the game has become too dangerous. And without artificial suppression, silver will finally be free to find its natural equilibrium. What is that equilibrium? It's a price high enough to incentivize new mining in a world where energy is expensive. It's a price that reflects silver's status as the unsung hero of the digital economy. It's a price that acknowledges scarcity. So what's the verdict for you, the individual investor? Strategy number 1, geographic diversification is dead. In a world of trade wars, moving metal across borders is becoming impossible. The safest place for your silver is where you are. If you're in the US, keep it in the US. If you're in Europe, good luck. Strategy number 2, ignore the spot price. The spot price you see on TV is now just a math error, an average of 2 broken markets. Value your stack based on replacement cost. If you sold your silver today, could you buy it back? What premium would you pay? That's the real price. Strategy number 3, the long game. The tariff on the UK is just the first domino in a shift toward resource nationalism. Every country is going to start hoarding what they have. Export bans, domestic allocation, strategic reserves. We're returning to a world where hard assets are the only collateral that matters. The tariff trap has locked the door. The silver is staying here. As we head into this week, expect chaos. Expect confusing statements from the banks. Expect volatility that makes your stomach turn. But you know the truth. You know that the logistics have snapped. You know that the trajectory is up and the floor is solid. The government has inadvertently rigged the game in favor of the physical holder. So hold your position. Do not get shaken out by the volatility. Eventually, the price will settle much, much higher than $90. Because the system that kept it artificially low is broken, the bridge is cut, the valve is closed, London is burning, the bridge is cut, and the fire is spreading. The Greenland Tariff was supposed to be about real estate. It was supposed to be about negotiating tactics. It was supposed to be a headline for a weekend news cycle, but it ended up being the trigger that broke the global silver market. A 10% tariff, a logistics wall, a one-way valve. The banks were playing a shell game for decades, moving metal back and forth across the Atlantic to suppress the price, to maintain the illusion of liquidity, to keep the paper market functioning. And in a single executive order, that game is over. The Roach Motel is open. Silver checks in, but it doesn't check out. We are watching the end of the globalized commodity market. We are watching the return of geography, the return of borders, the return of walls. And in this new world, the only thing that matters is what you can touch. Paper silver in London, worthless if London defaults. Futures contracts in New York, risky if the COMEX runs dry. Physical metal in your possession, priceless. Because you cannot print it. You cannot move it without penalty. And you cannot replace it at the old price. The media is laughing about Greenland, but the bankers are crying. And you, the silver stacker, should be paying very close attention, because the walls of the prison just got higher, and the silver is locked inside, with you. But here's the question nobody is asking. Was this really an accident? The tariff announcement comes on a Sunday, the quietest day for financial markets. It targets the UK, not just any nation. The UK, the home of the LBMA, the logistics hub that processes 70% of global silver flows. If you wanted to secure America's domestic silver supply without causing panic, you would create a tariff structure that makes export economically irrational. You would build a financial wall disguised as a trade dispute over an island nobody cares about. This doesn't happen by accident. The era of frictionless trade is over. The era of trapped assets has begun. And the only question left is, are you holding metal or are you holding promises? Because by the time the headlines admit what just happened, it will already be too late.